What if we told you there's a way to engage with the financial markets, make informed investment decisions, and maybe even outperform the S&P 500?
And doing all that by spending just a few minutes a month.
Exactly. It sounds almost too good to be true, right?
It really does.
Well, today we're diving deep into an approach that, believe it or not, promises just that.
We're looking at Fred Piard's book, The Lazy Fundamental Analyst.
Right. Piard, he's got this interesting background, PhD in computer science, self-taught in finance.
Yeah, he used his software architecture experience, looked at finance, and basically figured simpler is often better long-term.
And that, predicting group behavior,
Well,
almost impossible. So this book is his answer for individual investors wanting simple, effective, low-risk strategies. So our mission today, explore how this lazy but smart approach to fundamental analysis might just be your shortcut to being better informed and maybe more successful investing.
That word lazy definitely catches attention. But traditional fundamental analysis, it's a lot.
Huge amount of work, right?
Oh, yeah. Investors digging through financial statements, checking out management, competitor analysis, market trends. I mean, it's extensive.
Basically a full-time job.
Pretty much. And frankly, it's often just too much for most individual investors. You need the time, you need the skills.
Okay, so that's the mountain of traditional analysis. How does Piard's lazy way cut through it? What's the core idea?
Well, the thing is, lazy here isn't about doing nothing. It's about efficiency, smart choices.
Efficiency, okay.
It boils down to two main things: quantitative selection and diversification.
Quantitative selection. So numbers, basically.
Exactly. Instead of endless research trying to find that one perfect stock, you rely on just a couple of key financial ratios, numbers that have historically pointed towards success.
And you pick stocks almost blindly, just based on those ratios.
In a way, yes. And crucially, you don't just pick one. Diversification is key. Build a portfolio. Piard suggests at least 10 stocks.
Ah, so you spread the risk. You're not betting the farm on one company.
Precisely. It mitigates that idiosyncratic risk, the unpredictable stuff tied to just one company, like, a sudden scandal or a product failure.
Right. Diversification smooths out those single company bumps. Makes sense.
Yeah.
So that brings us to quantitative investing. What does Piard really mean by that, and why is being emotion-free such a big deal here?
Quantitative investing, the way Piard sees it, is about finding reasonable and measurable ideas, hypotheses about how markets behave.
Measurable hypotheses.
Right. And using those to make decisions confidently. The fantastic part, it takes your opinions, your gut feelings, your emotions right out of the equation.
Which can be a huge stumbling block for individual investors. Fear, greed.
Yeah, exactly. This makes it systematic, reproducible. You apply the same rules, you should theoretically get similar results over time.
And these aren't just abstract ideas. Piard makes them super simple, right? Strategies often based on just two factors.
Often, yes. Things like valuation ratios or maybe growth ratios. Very focused.
And the kicker is they're designed to be managed in just minutes a month.
That's the lazy efficiency part.
But it's not just theory. He tested this stuff rigorously.
Oh, absolutely. Back-tested over 15 years of data.
15 years. So they held up in different market conditions, bull markets, bear markets.
Across bull, bear, and even sideways markets, it shows they're resilient. It really speaks to the power of having a system, a data-driven approach.
Definitely. But does the same factor, say debt, mean the same thing for every company, regardless of industry?
That's a really important question. And the answer is no, not at all.
You can't compare apples and oranges.
Exactly. Piard makes a point of this. Take debt ratios. For a real estate investment trust, a REIT, high debt is kind of normal, part of the business model.
Right. They use leverage extensively.
But for a tech company, high debt might be a huge warning sign. Completely different context.
So the book accounts for this. It doesn't just apply one rule across the board.
Correct. It presents sector-oriented strategies. It uses classifications like GICS, the Global Industry Classification Standard, to group similar companies and apply factors that make sense for that sector.
That sector nuance seems critical.
It really is.
Okay, so we have these smart sector-aware strategies, but even the best strategy runs into bad markets sometimes, right?
Right.
Downturns happen.
Absolutely. No strategy wins all the time.
And this deep dive shows how vital portfolio protection is. Piard brings in hedging, using market timing indicators. Can you give an example?
Sure. He uses things like EPS estimate momentum. Basically, are analysts upgrading or downgrading earnings forecasts?
Okay, like a sentiment tracker?
Sort of. And also, unemployment momentum. Rising unemployment can signal broader economic trouble.
So using these signals to potentially get defensive.
Exactly. And the results he showed are quite striking. For one strategy, in consumer discretionary stocks.
Which can be very cyclical.
Very. Hedging cut the maximum drawdown, the biggest peak-to-trough loss, from a painful 61% down to about 27%.
Wow, that's huge. Less than half the loss. That's serious protection.
It really makes a difference in preserving capital during tough times.
So pulling this all together, what's the big takeaway for you, our listener?
I think Fred Piard's work makes a compelling case. It suggests that these disciplined, systematic, sector-aware strategies, even if they only take minutes a month to manage.
The lazy part.
Right. They can potentially lead to really impressive, consistent returns over the long haul, maybe even beating the benchmarks.
It really challenges that old idea that you have to be glued to the screen, constantly analyzing to be a successful investor.
It does. It suggests a different path.
So the final thought for you is, what stands out about this? How could a quantitative, emotion-free, systematic approach transform your financial strategy?
Even if it's just for those few minutes each month, maybe it's the idea that sometimes doing less but doing it systematically is actually much, much more effective.